Here's a wake-up call that should have every American worker paying attention. The job market confidence that we've taken for granted is crumbling faster than most people realize. A groundbreaking study released this Monday by the New York Federal Reserve Bank reveals that American consumers have developed a dramatically bleaker outlook on employment prospects during August, while simultaneously expressing growing pessimism about their personal financial circumstances. But here's where it gets really concerning. The Fed's comprehensive survey of consumer expectations, which gathered data throughout the previous month, uncovered a startling trend. A massive surge in the number of people who believe securing new employment would become significantly more challenging if they suddenly found themselves without work. The numbers tell a story that might shock you. Survey participants estimated their chances of landing a new position after becoming unemployed at just 44.9%, representing the most pessimistic outlook recorded in this particular survey since June 2013. To put this in perspective, this figure represents a substantial decline from July's reading of 50.7%, marking one of the steepest month-to-month drops in recent memory. And this is the part most people miss. The deteriorating job market sentiment extends far beyond just finding new work. Respondents also expressed heightened concerns about future unemployment rates climbing higher, while simultaneously anticipating increased likelihood of experiencing job loss themselves. The probability of losing one's current position now stands at 14.5% among survey participants, notably exceeding the 12-month average of 14%. Perhaps even more telling, August data revealed that workers have become increasingly reluctant to voluntarily leave their current positions, a clear indicator that people are prioritizing job security over career advancement or better opportunities. The reality check nobody wants to discuss. These troubling survey findings align perfectly with concerning trends emerging from official government employment statistics released over the past 2 months. The data paints a picture of significantly slowing job creation, accompanied by substantial downward revisions to previously reported employment figures that many economists had initially viewed as encouraging. Last Friday's Bureau of Labor Statistics report delivered what many consider a gut punch to economic optimism. Non-farm payroll additions managed only a modest 22,000 new positions, following July's already disappointing increase of 75,000 jobs. Meanwhile, the unemployment rate experienced an uptick to 4.3%, a level not witnessed in 4 years, raising red flags across financial markets. But here's where it gets controversial. The June employment data revealed something that hasn't occurred in 4.5 years. The economy actually lost jobs. This development has sparked heated debate among economists about whether we're witnessing temporary market adjustments or the beginning of a more serious economic downturn. Federal Reserve's response: too little, too late. The mounting evidence of labor market deterioration is providing significant ammunition for those advocating aggressive Federal Reserve intervention. Financial markets are now almost universally anticipating that the U.S. Central Bank will implement a 0.25 percentage point reduction to its short-term benchmark interest rate, bringing it down to the 4.00% to 4.25% range during the upcoming September 16th to 17th policy meeting. However, Fed officials find themselves navigating increasingly treacherous waters. On one hand, they're expressing serious concerns that President Donald Trump's trade tariff policies could exacerbate already persistent inflationary pressures. On the other hand, growing anxiety about labor market stability is rapidly becoming the primary driver of monetary policy decisions. Fed Governor Christopher Waller didn't mince words during a recent CNBC interview. "I've been clear that I think we should be cutting at the next meeting. You want to get ahead of having the labor market go down, because usually when the labor market turns bad, it turns bad fast." This statement raises a critical question. Are we already too late to prevent significant labor market damage? Financial confidence, a tale of two realities. The New York Fed survey also uncovered fascinating contradictions in how Americans view their financial futures. While respondents generally downgraded assessments of their current financial situations, the research revealed that year-ahead expectations about households' financial situations became more dispersed throughout August. What does this mean in practical terms? The survey authors explained that a larger share of households are expecting a worse financial situation, and an equally larger share of households are expecting a better financial situation in 1 year from now compared to July's findings. This polarization suggests that American consumers are increasingly divided about economic prospects, with some maintaining optimism while others prepare for financial hardship. The inflation puzzle, stability or calm before the storm, perhaps the most closely monitored aspect of this survey, involves inflation expectations. Despite widespread economic uncertainty, inflation expectations demonstrated relative stability during August. Consumers anticipate inflation levels of 3.2% over the next 12 months, representing only a slight increase from July's 3.1% projection. Looking further ahead, 3-year and 5-year inflation expectations remained unchanged at 3% and 2.9%, respectively. Federal Reserve officials are likely breathing a sigh of relief over these stable inflation expectations, as they suggest reduced risk that trade tariff policies will trigger sustained price pressure increases. But here's the million-dollar question. Can inflation expectations remain stable if job market conditions continue deteriorating at this pace? The bigger picture, what this means for you. These survey results paint a complex picture of an American economy at a crossroads. Workers are increasingly nervous about job security. Consumers are divided about financial prospects, yet inflation expectations remain relatively contained. For everyday Americans, this data suggests several important considerations. First, now might be an excellent time to prioritize job security over aggressive career moves, at least until labor market conditions stabilize. Second, financial planning should account for increased economic uncertainty, potentially emphasizing emergency fund building and debt reduction. Third, those considering major purchases or investments should carefully evaluate their decision timing, particularly given the Federal Reserve's likely policy adjustments. The controversial question nobody's asking. Here's what I find most intriguing about these findings. Are we witnessing a temporary economic adjustment? Or are these early warning signs of a more significant economic shift that policymakers are unprepared to address? The combination of deteriorating job market confidence, mixed financial expectations, and stable inflation projections creates an unusual economic environment that doesn't fit neatly into traditional recession or expansion models. So here's my question for you. Do you believe the Federal Reserve's anticipated rate cuts will be sufficient to address these growing labor market concerns? Or are we headed for a more challenging economic period that will require more dramatic policy interventions? I'm curious about your perspective. Are you seeing similar job market anxieties in your industry or community? Share your thoughts and experiences in the comments below, because your real-world observations might be just as valuable as these official statistics in understanding where our economy is truly headed.